Hello, I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, November 20th. Happy Thanksgiving, everyone. Hey, it's been a few weeks since our last perspectives video. We've seen an election that has resulted in the very predictable disputes, but with an increasingly clear winner in President-elect Biden. Georgians, you're going to have to endure 6 weeks of unprecedented spending on political ads. I don't envy you as a Peach State population. As we move closer to year end, COVID-19 continues to be the story, even as the economy continues to recover, and markets show that investors are optimistic about Pfizer and Moderna and then AstraZeneca today and other drug companies and their vaccine developments. So after a brief review of these indicators, we're going to finish with a look at why diversified investors have real reasons to be thankful this year and why a wrong comparison can take that thankfulness away if we're not careful. So the virus has certainly made a comeback. It's been in the news a lot. I'm sure we've all heard about it. Cases are up across the country, which is leading to some new slowdowns. Vaccine news continues to be very positive, but these numbers are a little disconcerting, as you can see. And it varies from state to state. And certainly different states are taking different approaches. Some of them have locked down their economies a little bit more than others. Others are trying to decide what to do next. But everybody's looking for a bridge to kind of get back past this period to the point where we can get widespread vaccinations and the beginning of that kind of herd immunity and see things get back hopefully to normal. But along the way, the economy continues to recover, and we can see that with employment numbers. Both of these charts show what are called continuing unemployment claims. You can see the chart on the right is kind of the overall number, and that's obviously decreased dramatically since its peak in April and May. And then if you look at the chart to the left, the one number that seems to get people a little bit concerned is that darker pink in the middle, which shows long-term unemployment claims, or people going off ordinary unemployment and onto a longer program. So some people, some jobs that we thought the job losses might be temporary, they seem to be maybe a little bit more long-term, and that does have economists paying attention. Obviously, the sooner that the economy can come back into full operating mode, the better for everyone. A few weeks ago, when we last talked before the election, we were asking the question, well, what kind of market should we expect between the election and Inauguration Day? And we looked at past market performance for previous presidential election years. And what we saw is, for the most part, markets remained positive post-election and pre-inauguration. And the question was, well, what do we think is going to happen this time? You know what? It's been pretty positive. This shows kind of major market returns since the election, kind of the blue dotted line there. And you can see markets generally, both inside the United States and outside the United States, have been positive since the election in early November. This, again, reviews market returns for the year. And the reason I put this one in there is because we're seeing a few things change that have been the pattern for the year. Remember, we've talked a lot about how large growth companies and companies with stock momentum have been the primary drivers of positive return in 2020. And those are represented by the red line, which is growth companies, large growth companies, and the green line, which is those with high or strong momentum. And then down below, you'll see the blue line and the purple line. Those represent small companies in the United States or large value companies. And what you can see is, though the red and the green lines have been the outperformers for the year as a whole, there's kind of been a turn since the election, which again is that blue dotted line. And what you see down here with the value companies and the small companies starting to turn upward is they're closing that gap between the momentum companies and large growth companies. People will refer sometimes to small companies or value companies as cyclical companies, meaning the kinds of companies or stocks that tend to do better when economies move into recovery. So it seems like the market is anticipating a strong recovery. We've certainly had the signs of that to start. If these vaccines continue to show promise and get through their testing and approval with the FDA, obviously it seems like the economy could come back relatively quickly. Another look that just shows those same factors, or those cyclical factors maybe coming into favor. If we look at things just in the month of November, this chart shows the names of different factors and their performance relative to the market as a whole, in this case using the S&P 500 as the market. And the ones in green are parts of the market that are outperforming the S&P 500. The ones in red are the areas or factors that are underperforming the S&P 500. Large cap growth, that one on the bottom, that's been the outperformer in the market for most of the year, but for the month of November, it's actually done a little bit worse than the S&P 500, while things like small cap value stocks and even some large cap value stocks have done better relative to the market. And again, that's that closing of the gap that we've seen in November. So here's a question to consider after looking at the markets. On March 23rd of 2020, would you have been thankful with breaking even on your stock portfolio coming into this holiday? I heard one of our advisors ask or make a statement about this to a client last week. And the comment was, if you had told me on March 23rd, when the market was at its bottom, that by Thanksgiving, my portfolio would be in positive territory, I would have been thankful. I would have taken that in a minute. Because if you remember where we were in March 23rd, earlier in the year, right as things really got kind of started with the shutdowns, the US stock market, represented by the S&P 500, that black line there, was down 30%. The blue line, representing companies outside the United States, was down over 30, and small companies in the United States were down almost 40%. So things were looking pretty bleak, and there wasn't a lot of hope on the horizon as the virus really took hold and all the economic shutdown, both here and abroad, were taking place. So our expectations, while they might not have been very favorable at that point, we didn't know then that March 23rd was going to be the bottom of that market cycle. And sure enough, things turned around, and where we are today, companies outside the United States, that purple line, the ACWX, All Country World ex-US, up almost 4.5% year to date. And the S&P 500, represented by SPY here, up almost 12%. This was year to date as the end of the day on Friday. So again, if you would have said, hey, are we going to be positive by the end of the year? And you would have been thankful with that. This chart delivered. We should be having some pretty good thoughts about, oh gosh, this is actually turning out better than I thought. But let me show you another picture and see how you feel about that. In this chart, I add in the big tech companies and how they've done year to date. So FanMag down here, Facebook, Amazon, Netflix, Microsoft, Apple, and Google, those 6 companies year to date combined have averaged return 44.8%. That's a big number. So if you look again at the S&P 500 and that all country world index outside the US, all of a sudden 12 and 4 maybe doesn't look quite as good as 44.8. If you think about the S&P 500 without those 6 stocks, it would have only done 3.5% because those companies represent 21% or more of the S&P 500. So as the return of those 6 companies have gone this year, it seems like, wow, that's what's really driven most of the S&P 500 performance. So what if you kind of looking back and going, gosh, I wish I would bet on big tech instead of a diversified portfolio? Well, let me give you a couple other parts of the economy that you could have chosen to invest in. How about big banks? If you'd invested in big banks this year, let's say Bank of America, you'd be down 22% still. If you had invested in Wells Fargo, you'd be down 50%. JP Morgan, 14% down. PNC Bank, almost 16% down. US Bank, down 25%. So, the big bet on big banks would not have been a good one. Or how about big oil? ExxonMobil is down 42%. BP is down 44%. Royal Dutch Shell is down over 40%. Chevron's down 24.7%. The reason I read these numbers off is because the S&P 500 or the US stock market is an aggregation of all these different sectors, all these different companies together. And historically, it's been very hard to predict which sector or which companies are going to do the best. It just happens that this year, and really kind of the previous year and a half or two, big tech has been the big winner. But again, if you look at that S&P 500 return of 12.7% year to date, given what we knew in March, I think many of us would have taken that and been very happy. The problem is comparisons like this can make us feel some feelings of regret. We feel like we should have maybe seen this coming and chosen, in this case, big tech over big banks or big oil. As humans, we all have a tendency towards this thing called hindsight bias, the condition that makes us believe the future is predictable. It's never been predictable. We know that, and most likely never will be. The truth of the matter is that predicting which stocks or sectors will win in the coming 6 months or 12 months is a bit like placing a bet on a roulette wheel, red or black. Except in the case of the stock market, the choice is not between 2 colors or 36 numbers. FanMag or FANG stocks, they represent 7 companies or 7 stocks, 6 companies, really. Google has 2 share classes. But those 6 companies are 6 of 3,500 companies in the United States. More than double that if you include stocks outside the United States. Granted, these 6 companies are now enormous, However, historically, smaller companies and lower price value companies have actually had higher returns than the larger, highest priced ones, especially for long-term investors. There's going to be lots of lessons to learn from 2020 in retrospect. One lesson that investors seem to have to learn again and again is that uncertainty is simply a given in the markets and in the economy, and diversification is a very, very reasonable response. So as you evaluate your investment portfolio this year, try to remember how you felt in March, when breaking even for the year would have been a welcome result for many of us. Overall, diversified investors do have much to be thankful for, one of the quickest market recoveries ever. Remember too that predicting which stocks or sectors will do well is very difficult. It only seems easy in hindsight. Unlike the roulette wheel, the market allows you to put money on every number and still have the potential to come out ahead. That's the power of diversification and a key difference between investing and gambling. Long-term investors understand that the comparisons that matter are not about what happened this year. What an outlier. But what happens over the next 10 and 20 years relative to achieving our goals and managing risk. Even if your portfolio doesn't look like the big tech numbers right now, or even just like the market, diversified investors really do have much to be thankful for this holiday week. So don't let unrealistic comparisons spoil your turkey or your cranberries or whatever else your holiday traditions are, the ones that you're going to still be able to observe this week in this very unusual year. Let's close out with a quotation that I really like. He is a wise man who does not grieve for the things which he has not, but rejoices for those which he has. I think for many of us, we can find things to be thankful for. Hopefully this week, as you gather with those who are close to you, you'll still have a chance to do that. And as we look back at the year, you can go, things could have been a lot worse, and actually things have been pretty good in the midst of a really hard time. We'll talk to you in a couple of weeks. Hopefully there'll be a little bit more closure to election results. We'll see what markets are doing, and we'll hear about Thanksgiving. Have a great one. Thanks.